In 2023, a 58-year-old engineer named David sat down with a tax advisor for the first time since he'd started working. He had $412,000 in his 401k. He'd maxed it out every single year for 19 years. He did everything right. And his advisor told him something that genuinely floored him. When he retired at 65 and started pulling that money out, the IRS would collect more from him over the course of his retirement than the total tax he'd ever deferred putting that money in. This video is for educational purposes only and is not financial advice. Now, let's unpack exactly how this happens. The 401k was created under the Revenue Act of 1978. Congress wanted to give working Americans a way to defer paying taxes on a portion of their income until retirement. The logic was simple. You earn money now, you're probably in a higher tax bracket now. You retire, your income drops, you pay taxes at a lower rate. You keep the difference. That logic made sense in 1978. The problem is that a lot has changed since then. And the math that made the 401k look like a pure win has quietly stopped working the way most people think it does. Here's the core setup. Every dollar David put into his 401k reduced his taxable income the year he earned it. So if he was in the 24% federal bracket, he effectively got 24 cents back on every dollar he contributed. That's real money. $23,000 contributed in a single year. At 24%, that's about $5,500 in deferred tax, gone from his tax bill today. But here's what most people don't think about. That entire balance, every dollar of growth, every dollar of reinvested dividend, every dollar of compounding, all of it is ordinary income the moment he touches it in retirement. Not capital gains rates. Ordinary income rates. And if he's done everything right, if he's saved consistently for decades, if the market cooperated, he could be pulling out $60,000, $70,000, even $80,000 a year, which puts him right back in the same bracket, or a higher one, than when he was working. Think about that. Has your own advisor ever walked you through the tax rate you'll actually pay when you withdraw? Drop your answer below. It's one of the most skipped conversations in personal finance. Here's where David's situation gets specific. Under the Secure 2.0 Act, which Congress passed in late 2022, the age at which you're required to start taking money out of your traditional 401k moved to 73. Required minimum distributions, you don't get to leave the money in there forever. The IRS has a formula based on your account balance and your life expectancy, published in the IRS Uniform Lifetime Table. And at 73, for a balance of $900,000, which is roughly where David's account projects to land if it grows at 6% annually between now and retirement, his first required withdrawal is about $36,000, just from the RMD. Add Social Security, maybe $40,000 a year for someone with his earnings history. That's already $76,000 of taxable ordinary income before he buys a single thing in retirement. He's back in the 22 to 24% bracket. Now run the math forward. David deferred tax at 24% going in. He pays tax at 22 to 24% coming out. He didn't beat the IRS. He lent them an interest-free loan for 30 years and got almost nothing for it. And that's the best case. The worst case involves something called bracket creep, and it's not theoretical. It's already baked into current law. The Tax Cuts and Jobs Act, passed in 2017, cut individual income tax rates significantly. The top rate dropped from 39.6% to 37%. The 25% bracket became 22%. Rates got meaningfully lower, but, and this is critical, those cuts expire after December 31st, 2025. Unless Congress acts, and as of now there is no guarantee they will, the tax brackets automatically revert to their pre-2017 levels. That 22% bracket becomes 25% again. The 24% bracket becomes 28%. David's advisor ran both scenarios. If the cut by David's effective tax on a $400,000 cumulative withdrawal over 20 years, that's an additional $8,000 to $12,000 paid to the IRS conservatively. On a realistic $900,000 balance, we're talking significantly more. He deferred tax at rates that were already relatively low. He'll pay at rates that could be higher. That's the uncomfortable math the title promised. There's a third mechanism David's advisor brought up that almost nobody talks about. It's called the provisional income threshold, and it's been sitting in the tax code since 1983 under the Social Security amendments. Here's how it works. Up to 85% of your Social Security benefit can be taxable, depending on your total income. The threshold that triggers full taxation on that 85% is $44,000 for married couples filing jointly. That number has not been inflation adjusted since 1983. So when David is pulling $36,000 in RMDs plus $40,000 in Social Security, his provisional income calculation pushes him well past that threshold. His Social Security benefit, money he paid into for 40 years, becomes mostly taxable income. The 401k distribution triggers the Social Security tax. The Social Security tax adds to his ordinary income. The combined income pushes his effective rate higher. It's not one mistake. It's three mechanisms that all feed each other. If this is changing how you think about your own retirement accounts, this is exactly what we do here. One financial story per week, built for people who are still building wealth, not people who already have it. Subscribe, and next week's story might be the one that actually moves the needle for you. Now, here's where we have to be honest about the counter-argument. Because some people hear this and say, okay, I'll just do a Roth 401k instead and pay the taxes now. And for a lot of people, that's genuinely the right call. But it's not automatically the right call for everyone, and here's why. If you're in your peak earning years right now, say you're 42, making $160,000, and you're in the 24% bracket, paying taxes now on that full contribution, the traditional 401k still gives you a real tax reduction today that lets you invest the difference. The real answer isn't traditional bad, Roth good. The real answer is tax diversification. And this is the thing David's advisor told him he wished he'd heard at 35. Think of it like this. Your retirement income is a faucet. A traditional 401k is hot water, all taxable. A Roth account is cold water, all tax-free. A taxable brokerage account is warm water, capital gains rates. If you only have hot water, every sip in retirement is taxable ordinary income. If you have all three, you can mix the temperature to stay in the lowest possible tax bracket every single year. That's not a metaphor. That's literally what sophisticated retirement tax planning does. It's called bracket filling. You pull just enough from the traditional account to reach the top of a low bracket, then you pull the rest from Roth, and your effective tax rate stays controlled. David had only hot water. 19 years of maxing the traditional 401k with nothing in a Roth and nothing in a taxable brokerage. That's the actual mistake. So what does someone in David's position, or someone at 30 or 40 who still has time, actually do? The first move is to check whether your employer offers a Roth 401k option inside your existing plan. As of 2023, most large employers do. You can split your contributions, put some in the traditional side to get a partial deduction today, and put some in the Roth side to build a tax-free bucket for later. There's no rule that says it's all or nothing. The second move is to open a Roth IRA if your income qualifies. In 2024, the contribution limit is $7,000 per year, $8,000 if you're 50 or older, and the income phase-out for a single filer starts at $146,000. If you're over that limit, there's a legal strategy called the backdoor Roth conversion that some people in this situation use to get money in anyway. That's a whole separate topic, but it's worth knowing it exists. The third move, and this is the one David is actually doing now, is a Roth conversion ladder. He's converting a portion of his traditional 401k into a Roth IRA each year between now and retirement, paying the taxes now at current rates, before the Tax Cuts and Jobs Act cuts potentially expire, and before his RMDs force the issue. It doesn't feel good to write a check to the IRS today, but it may be a lot cheaper than writing a much bigger one at 73. What's your current split between traditional and Roth accounts? It's more telling than most people realize. Drop it below. David did everything his HR department told him to do. He maxed out. He stayed the course. He didn't panic sell. And he still ended up in a situation where the IRS collects more from him in retirement than the total tax he ever saved going in. That's not a failure of discipline. That's a failure of information. The backdoor Roth conversion, how it works, who it's actually for, and the one step people skip that triggers a surprise tax bill, that story is already on the channel.